It's going to zero. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, global leaders panic over a major country's currency meltdown. And I want you to understand the severity of this because of the direct impact on global trade. It leads to debt defaults, and I'll show you how it leads to recession each and every time. But if you think the U.S. is immune to this, it's not. I'll show you why it'll have devastating consequences to our economy as well. And yet there's one institution that holds the power to put an end to all of this, and they're doing nothing, and instead they're going to let the world spiral into an all-out currency crisis. Now let's go to Bloomberg, where he picked today's story up with a headline, as the yen's tumble to the weakest since 1986, boosts the risk of intervention, because when a currency spirals out of control, it puts a halt to trade. Because when you think about it, if you're trading in this country's currency and it's spiraling down, you don't want to take it anymore. And that's an issue. And so what policymakers need to do is put a halt to this, or at least attempt to. But the problem is they have no idea how to put an end to what's going on. The Japanese currency fell as much as 0.6% to 160.62 per dollar, blowing past levels that led officials to intervene in the market back in April. The yen has weakened more than 12% this year, raising the price of imports, hurting Japanese consumers, and causing growing unease among businesses. And of course it impacts consumers, because businesses have to start raising their prices at a time when consumers around the world can't afford it. And you start to see the setup of why this causes recessions. And the reason it leads to debt defaults, well, I'll talk about that in a moment. But here you can see the impact it has on consumers, because when we look at the U.S. data, we see the consumer price index in blue against total compensation as shown by average hourly earnings multiplied by average weekly hours of production and non-supervisory employees, both on a year-over-year rate of change. And you'll notice that you'll see periods where inflation, as shown in the blue line, is rising and total compensation is decelerating, and then all of a sudden a gray shaded bar shows up because it means there's a recession. And what's happening in these instances is prices are rising and consumers can't afford them, and that's what drives the economy into recession. And that's the problem Japan's facing, because as their currency spirals lower, businesses naturally have to raise their prices. Consumers have no ability to deal with that. And you can see here in the 1990s in the US, the early 2000s, the global financial crisis, in each instant what we saw was rising inflation against a slowdown in total compensation. Right now the fear is total compensation will continue to fall and inflation will not fall fast enough. We'll see in the months to come who is going to take the lead on the way down, because Kanada, Japan's Vice Minister of Finance and Currency Chief, said that on Wednesday officials are watching the foreign exchange markets with a high level of urgency and would take appropriate steps as needed. Now, if they actually knew how to put a halt to this, they would have done it by now. And that's the problem. They're hoping that something just stops the free fall of their currency, because what they have to do is sell their foreign exchange reserves, perhaps sell, of course, foreign government bonds to raise cash. And what they'll have to do is sell that onto the open market and then buy their currency back to try to put a stop to it. And well, of course, we know it doesn't generally work, and that's why they're not doing anything just yet. He described the currency's latest moves as rapid and one-sided, but refrained from commenting if currency moves are excessive. He doesn't want the market to know they're powerless to stop it. And the yen extended losses after his remarks. And so you start to think about how currency crises lead to debt defaults. And well, it becomes very simple, because if you're in Japan and you have dollar-denominated debt, it now takes even more yen to sell on the market, driving the cost of that currency down to get precious dollars that are going up in value to pay on your debts. And that's why things tend to implode when you see currency crisis. And one thing that's going higher and higher, well, that's oil and the trade we put on for our subscribers. Here you can see the headline from yesterday. Oil prices still holding up even after today's inventory reports. We'll talk about that later. On the 11th, to our CTA Timer Pro subscribers, I noted this is one they should hold off on as I give them details on each and every trade. And then on the 12th, I said now it's a go. If we've hit our upside downside targets and prices continue to go. We revise our stop loss levels, so we give you all the information each and every day that you need. And what are we trading here? We're trading against the machines. We're trying to beat them because when they get in deep short positions and price moves against them, well, they have to short cover them by large amounts of money. We noted after our trade came on, they had to buy $30 billion worth of U.S. oil. That trade, even after yesterday's pullback, is still up 2.69%. That is quite impressive. And the best part of all is you can get a 30-day free trial. No one else I know does this. 30-day free trial. Start making money trading. We show you step by step how to do it, because the rhetoric from the Ministry of Finance in recent days has signaled increased concern, and he expects officials will hold out for the currency to slide to 165 per dollar before entering the market, a level that banks, including Bank of America, now say is the line in the sand for authorities. And keep in mind, when the currency reverses, our subscribers are going to know and take big advantage of that. You can too. Again, links in the description below, because a lot is at stake for your trading account as well. As Japan, which spent a record 9.8 trillion yen in its most recent bouts of intervention. Citigroup estimates the country has 200 to 300 billion worth of ammunition to fund any campaign. This is referring to foreign currency reserves that the Bank of Japan would be willing to sell to buy its currency back. Of course, the issue here is Japan's economy is slowing down. The dollar is on a tear. And as I mentioned in the beginning of the show, there is one institution that has the power at least to put a stop to this. And while they're not doing anything, the vast gap between interest rates in Japan, where borrowing costs remain near zero, and the U.S. has kept pressure on the yen despite attempts to contain the slide. And that's part of the problem here, is why, if you have money in Japan, would you want it there earning zero when you could just take that money, convert it to dollars, put it into the U.S. and earn a much higher interest rate? And that's exactly what's happening here, is money is flowing out of China, is flowing out of Japan, is flowing out of other countries into the U.S. And of course, it has everything to do with a discrepancy in monetary policy. The next big pain point may emerge from a readout on the Federal Reserve's favored U.S. inflation gauge coming tomorrow, which is key to the outlook for monetary policy. And what we know is that investors and traders are looking to the Fed to put an end to this, because if this continues to spiral out of control and the yen continues to drop, well, it could have devastating consequences on the markets. And this is something investors don't want to see, and they're hoping tomorrow the data suggests that the Fed may be cutting sooner than they think. Of course, we'll find out more tomorrow, as the finance minister, Suzuki, said they're closely monitoring developments in the market, will take all possible measures as needed, so far, which are none. And we talked about how currency chief Kanata had warned on Monday that authorities stand ready to intervene, again doing nothing as they stand by 24 hours a day, if you can imagine, while reiterating that we're not targeting a specific level because they don't want the market to know. If the market found out they were targeting a level, you can guess what's going to happen. The market is going to drive the yen down to that level and try to test the resolve of the Bank of Japan. They're hoping this somehow comes to an end, but there's no sign it is at all. And I have serious concern about the recent rapid weakening of the yen, and we're closely monitoring market trends with a high sense of urgency, because they know this can be an all-out panic mode. It will send Japan's economy into recession when consumer spending grinds to a halt. It will start to lead to debt default, as people who owe money in dollars cannot get them, and that is a problem, and it will have an impact on global trade because people will stop wanting to use the yen, and that is an issue. It is a big problem for the country, and they're looking to take any necessary actions against excessive movements, but doing absolutely nothing right now. And it's crazy for Japan to intervene on the yen before Friday, this according to traders who are looking to continually smash the yen down, as Japanese authorities will wait at least for the PCE data on Friday to decide on intervention. At least that's the hope, even if the price breaks through 160. A stronger than expected report, this being from the personal consumption consumption's expenditures could spur volatility and send the yen hurtling toward 163, spurring officials to make a quote rate check or intervene during a period of thin liquidity. And what, of course, investors are hoping is a personal consumption expenditure report is going to come in weaker than expected, meaning that they hope that the Fed will cut sooner than expected, will actually take some pressure off of the yen. The question is, will it? Well, based on the relationship between the consumer price index shown in blue and personal consumption expenditures shown in red, it does actually suggest that PCE could actually go higher with a print tomorrow. That, of course, would put markets on edge, send the yen crashing in a major way, which is why it's sending the dollar higher. We talk about how this is going to impact the U.S. economy, and the dollar is the wrecking ball. The higher the dollar goes, the more problems we face as the dollar soars to fresh 2024 high as Fed diverges from major peers holding rates at levels which are going to seem completely unreasonable. And you can see the effects of the dollar on inflation as we look at the consumer price index in blue against personal consumption expenditures in red, also now showing the nominal broad US dollar index in green. And you can see periods where the dollar is steeply rising, and that causes inflation here in the US to come down. There's a reason why the Fed isn't actually too upset about this, and they're hoping that, of course, what goes on in Japan is not going to spill over to the rest of the economy. What they don't seem to realize is a strong dollar is going to cause problems with the U.S. economy as a whole. Yes, it may bring inflation down, but it will cause problems, and we see that now in the U.S. new home sales. It crashed outright in May. New home sales crashed 11.3% month over month, which was staggering, and of course, that was after April's 4.7% drop was massively revised higher to 2% gain. That's the biggest month-over-month drop since September of 2022. And here you can see this is just plunging, suggesting that at a time we should be seeing lots of home sales. Demand here in the U.S. is going away. And this also came to the biggest year-over-year drop since February of 2023, taking the seasonally adjusted rate down to the same level it was back in 2016. And that also is impacting, of course, in the commodity markets as WTI dropped just a little bit on large gasoline bill before buyers came back in as oil demand is slumping. And what this is doing, it's impacting the U.S. economy. We're seeing demand here start to weaken in the housing sector. Now in the energy markets, this is going to lead to more job losses in a big way, as we see here. Despite, of course, these builds, crude inventories up 914,000, gasoline inventories up a huge 3.84 million. Remember, this was supposed to be big drop after big drop every week, and jet fuel or distillates dropped 1.18 million barrels. And of course, what's surprising is oil prices held up, and that means our subscribers continue to make money on this trade. And that means, of course, when we see oil prices, that also has an impact on personal consumption expenditures. Now taking away the dollar and overlaying West Texas Intermediate in green, we can see the year-over-year rate of change for West Texas Intermediate is in the plus, and that should have some upward pressure on the consumer price index as well as personal consumption expenditures. The only question remains is demand in the U.S. economy dropping fast enough to offset rising energy prices? We'll find out more tomorrow, because now it's all coming down to this PCE report, and will the Fed actually cut rates? The market's hoping, because they have the power. The Fed has the absolute power to put an end to the decline in the yen. If they start cutting rates, the market would take that as dollar bearish. But instead, the market reacted in a very strange way today. It did send the dollar higher, but look at this Treasury slide as a weak yen offers another reason to shun bonds. And this makes absolutely no sense, because if the dollar is rising and is out of control, what do you need it to do? You need it to get weaker. And how do you create dollars? Well, you create it through the commercial banking system, and the market's reacting by, wait, Bank of Japan may have to sell a bunch of treasuries that will drive yields higher. Well, that's not doing anything for the creation of credit. It's not going to really put a dent in the ascension of the dollar. This is a major problem, and the market is completely misreacting to it as yields on long-dated securities led the move with 10 to 30-year rates more than 5 basis points higher on the day. The 10-year notes rose as much as 7 basis points to 4.32%, and the reaction of the U.S. government bonds to yen weakness reflects the prospect that Japan could liquidate some of its Treasury holdings to defend the currency. The reality is, if they did, there are ample buyers out there. We know that, of course, foreign investors, even those in Japan, can't get enough treasuries due to the yield and safety of investing in government securities. And that means, of course, U.S. bond traders are likewise battling doubt about whether the Federal Reserve will deliver rate cuts this year and being ultra sensitive to every bit of news that comes out day to day. They no longer fully price in more than 1 by the year end, compared with 6 at the start of the year, as Fed Governor Michelle Bowman on Tuesday said expected rate cuts would begin in 2025. Of course, she's way off on this. If, of course, the yen blows up and the Japanese economy goes, well, that means they'll be cutting as well as we will. And later on Tuesday, a sell-off in Canadian government bonds sparked by unexpected inflation acceleration bled into treasuries. The reality is, if other countries are starting to see inflation pick up because of a stronger dollar, that means U.S. inflation in the months to come is likely to head much lower. That means it takes pressure off of the Fed and gets them in a position to cut rates. But will it be too little, too late? Well, if the yen continues its free fall, well, it means we're set up for an all-out currency crisis. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.